All right, welcome everybody to another episode of the Olympus Wealth Strategies podcast. I'm your host, John Sidery, where we help you take your finances to great heights. Very blessed to have a special guest with us for this episode, Adam Patti, the CEO of VistaShares. He comes with extensive knowledge and background that's really second to none, and we're very thankful to have him on the podcast. And Adam, thanks so much for coming on.
Thanks for having me. It's a pleasure.
Well, maybe we can just kind of dive right in, and for our listeners to kind of get up to speed, for those who maybe don't know you, maybe your background, kind of what has led you up to this point, and then we can dive a little bit further in.
Sure. I've been in the ETF market since way back in '01, and believe it or not. That was really early days. And I worked for Time Warner, and one of my responsibilities was running an indexing operation for Fortune magazine. So we created the Fortune 500 index, and we had an ETF based on that. We work with State Street Global Advisors, and we launched the Triple F. And that was really my first foray into the ETF market, really trying to understand the industry, learn about it. It was brand new. Fast forward, I started a company called Index IQ back in 2006. And we specialized in liquid alternatives. So we were the first company to really try to bring institutional class investment strategies and embed them in the ETF structure. Built that up, sold that to New York Life back in 15. Was at New York Life for 3 years, helping them build out their global ETF platform. And then I left and was stuck out of the industry for a few years on a non-compete, trying to, hoping to get back in. I love the industry. And while it is certainly more mature now than it was back in 15 and certainly 2006, there's a lot of white space. And, I just really believe in the ETF structure, just as a better investment vehicle for investors, with, the low cost, the transparency, the tax efficiency. And, was excited to get back in to start VistaShares about a year and a half ago at this point.
Well, obviously, you being an early adopter in ETFs, right? 2001, you were probably still up against the mutual fund machine, right? Until now, you look at the flows of the landscape on that front, and it's very much investors and I think advisors across the board have adopted the advantages of ETFs compared to a very similar mutual fund.
And it's interesting that you say that, because even back in 2015, and when I sold Index IQ, it was still part of the conversation with advisors on the benefits of ETFs versus mutual funds. That was, you still had to go through 6, 7, 10 minutes on that. Now it's not, that's not, to your point, not part of the conversation anymore. Everyone understands them. They understand how to trade them and how to use them. And now it's really just a focus on, the investment strategies embedded in them.
Well, maybe Adam, can you talk a little bit about VistaShares? Maybe why you obviously as a multi-company entrepreneur, you decided to get back in the space, launch VistaShares, and maybe talk about maybe your differentiation from, to be honest, somewhat of a crowded space right now that ETFs have become so popular and so widely adopted, and their benefits from a tax standpoint very widely known. Maybe what the differentiation is on VistaShares, and maybe the things that you do differently from a competitive standpoint.
Sure. So, way back, starting, really beginning of my career in ETFs, particularly when I did Index IQ, I was really focused on institutional class investment strategies. How do you bring, high quality strategies and put them into an ETF structure to make them, more accessible and really democratize access for investors? So, that has always been my thing. So I knew whatever I wanted, whatever I did, it had to focus on that. It's all about the quality of the product, because in my mind, particularly in a more mature industry as we are now, Index IQ is the 18th ETF issuer in the country, believe it or not, when I launched it. Now there's hundreds, right? So it is definitely more crowded. But, I believe firmly that if the product is high quality, you will eventually differentiate yourself. So the question for myself when starting a new company was, how do I do it? How do I do something special, or at least something that I think is special? I had the opportunity to meet a guy named John McNeil. John is an incredible entrepreneur, business person. He was the president of Tesla. He was the chief operating officer at Lyft. He's on the board of General Motors. He's vice chairman of their GM's autonomous vehicle division or subsidiary. He's on the board of Lululemon. He's on this board, that board. He is an incredibly accomplished person. He also runs a company called DVX Ventures, which he calls a venture studio, and I just usually call it like a think tank. So what it is it's some really smart people that he has working with him, where they analyze industries to try to determine, where could they be disruptive. So, that's how he got interested in the ETF market. We got together and formed VistaShares. And the reason why he got interested in the ETF market, it's an interesting story. He was on an interview on CNBC with Joe Kernan, and they were talking about AI because John is an AI guru. And Joe's like, well, how do you invest in this? How do you get exposure to AI? So John's like, well, there's got to be an ETF for that. And, of course there are. But when he went back to look at the ETFs and look under the hood and what the portfolios look like, lo and behold, the portfolios didn't really mirror the naming of the product. So if it called themselves an AI ETF, you look under the hood, you've got Salesforce and Netflix and all these other companies in there.
Anything that probably was related and coded under technology from Morningstar.
Exactly. So not a lot of thought goes into building some of these portfolios. And look, some of them are great out there. Some of the products are great, but others are just kind of put together. So, he saw that and said, wow, there's got to be a better way. And that's how we got together. So how do we put our heads together to create better product? And, he had this whole concept, which we can talk about more later, about super cycles, which I can get into his philosophy behind that. But what VistaShares is really focused on is bringing, institutional class strategies in different flavors. So, we're not going to be everything to everyone, but we do need products that are designed to perform in different market conditions. Right? We don't want all growth equity or all, whatever it may be. So, we're choosing product families to go deep into where we think we can have a competitive advantage, but that gives investors different options or different tools to improve their portfolios, whether the market's going up, sideways, or down.
And really, like you said, as opposed to having, and nothing inherently wrong with this, but as opposed to having another large cap growth fund or another S&P 500 ETF, right, where everybody and their brother has that offering. You really are going deep on different thematic investments. And like you said, between you and your partner and the broader VistaShares team, how can we maybe take advantage of these opportunities, pull that into a fund and benefit ultimately a client's portfolio? Before we dive into, like you kind of alluded to, super cycles and some different investment themes that you all have at VistaShares, can you kind of give us a high level, maybe big picture view of what you think is going on in the economy right now, maybe some opportunities, how that plays into your different investments offerings that you have right now?
Sure. So look, I'm a bull, long-term, mid-term bull. I do believe that there are some structural issues in the markets now that investors and their advisors need to be cognizant of. We've been in a multi-year secular momentum-driven market where, the leadership in the market has been fairly narrow, focused on the mega cap tech companies largely. And, what many advisors don't know is that, or don't really pay attention to, is that if you look at the S&P 500 and the Qs, the top 10 holdings, there's massive overconcentration risk, right? I mean, the top 10 holdings in the S&P is 43% of the total exposure at this point. Same thing, or even more so on the Qs. And the problem is that the overlap between the two are, 8 out of 10 or, 7 out of 10. So when advisors or investors are using those broad indexes to diversify their portfolios, they're not actually getting much diversification at all because they own the Mag 7 Plus, then they own those again in their AI funds, and they own them again in their single stock portfolio. So if we do see a sustained drawdown, my premise is that those are the companies that are going to get hit first, and investors are going to get hurt. So I am wary about what's going on in the short term. And I believe that, investors just really need to take a hard look at their portfolios to make sure they're diversified. And that really goes to the types of, solutions we're bringing to market, because if you look under the hood on our portfolios, They all look very different than one another, and they're completely different than anything in the market. And that's really what we're trying to do, is provide unique exposures for diversification purposes. And I think that's important. So, yeah. So look, I think the market is, and the economy seems to be doing fairly well, despite the shutdown and all the headwinds. There are some geopolitical risks that we all need to be wary of. And I just think you just need to be, diversified, patient, and whatever you do, don't sell into a drawdown.
Well, and that's really good insight and advice, and honestly, something that I think, whether it be the clients themselves or even us advisors need to be very mindful of, is exactly what you highlighted, right? It's the over concentration in all these indices, and just buying these different index funds, thinking inherently there's diversification between the two. They become much more aligned than they are different, and just buying those few different funds, like you mentioned. That can lead to obviously a lot of over concentration, and if there's a market pullback, you really just have double the exposure into the names that you thought were maybe different. Let's maybe, Adam, dive into a little bit more about the differentiation of VistaShares. So you kind of alluded to this, the super cycle. For our listeners, obviously one of the pillars that you all have is that super cycle terminology. Can you talk about really what that is and how it's different and ultimately what it's used for?
Sure. So the super cycle concept is actually John's vision and what really got him interested in getting into the ETF market. So what a super cycle is, it's a kind of long-term technology driven disruption in the economy. So if you go back 100 years, 150 years, whatever it may be, there's never been a point in time where there's been more than one super cycle occurring at the same time. We had the advent of electricity, way back, right? The last super cycle was the internet, right? Massively disruptive, completely changed the way people live and work, and created a lot of economic opportunity. But now, and he says it a lot more eloquently than I do, but now we have multiple super cycles occurring at the same time. So we all know about AI. Then there's the electrification portion of that, where the grid is 40 years old, needs to be upgraded. So electrification is another super cycle that's occurring. Robotics is another. Biotech is going along there as well. And in fact, there maybe even space. So, if you look at what's going on, all of this is happening at the same time. Which is incredibly exciting from an economic perspective, where there's going to be a lot of ways to make money, but it's also going to be extremely disruptive to the way people live and work. And people need to learn new skills. People are going to have to learn how to, use these technologies to their benefit. So, and we're really just in the beginning phases of this, which is really interesting. So AI, for instance, is we believe we're still in the very early days of that. But the problem is, from an investor perspective, when people say, I'm going to invest in AI, what does that mean? I'm going to buy Palantir. No, I'm not opining whether it's a good company or not. But, you got to look where the capital is being invested. So the way we look at super cycles is, it's from a supply chain perspective. So if you look at AIS, our AI infrastructure ETF, or we just launched POW, which is our AI energy infrastructure ETF, we take a very different approach. We don't just create an index and throw in Netflix and Tencent and Alibaba and the Mag 7 and stuff like that. Those are not AI companies. They hope to become AI companies down the road, but for them to become AI centric, they need to invest hundreds and hundreds of billions of dollars to improve the infrastructure, to enhance the level of computing power that they have access to, so that one day they can create these high-powered, consumer-focused applications that benefit their consumers and make them money. Right. So when Meta says, they're going to put in $100 billion into AI, what does that mean? So that's where we start. Where's the money going? So for AIS, for instance, we analyze the supply chain. So what's step one? Where's the money going? It's going into building data centers and semiconductors. Great. What does that mean? Then we map out the supply chain in each one of those components to determine what pieces, what companies, or what are the pieces that go into building an AI data center, for instance. Once we understand that, then we overlay what's called the bill of materials. So, John and we have this guy, Sunny Madra, who's the president of a company called Grok. He's one of the biggest AI luminaries in the world. He's on our investment committee as well. We map out, we create this bill of materials to overlay on the supply chain, because fine, it's nice to know that fiber optic cable is important, but how important is it within the build sheet, basically, if you want to just dumb it down as much as possible. So what you find, and this is, you find some interesting insights. So for instance, most people don't know that about 30% of the cost of an AI data center goes into cooling systems, boring old cooling systems, right? So, that's an AI company. Those are the ones that are soaking up the cash, 30% on the dot, 30 cents on the dollar.
But extremely important when it comes to all the power that's needed for computers and in the enhancements of our computers and AI and ultimately, if we get into the whole quantum computing, right, the cooling of those computers and technology is essential.
Exactly. 100% right, on the nose. So, once we've overlaid the bill of materials to see how important these segments are, then what we do is we find the company. So, okay, here are 10 cooling companies. And this is where the hard work starts. We dig into the financials and determine, all right, this is a cooling company. Are they in data centers? Okay, we don't care if they're in data centers. We care if they're in AI data centers. We have to actually dissect their financials to determine what their pipelines look like and determine how important AI pipeline is to their business. And we do that across the entire supply chain. So in AIS, we're doing it for data centers, and we're doing it for semiconductors, for POW, our energy infrastructure ETF, which we could talk about more, but we're looking at transmission, distribution, and generation to figure out the same thing. And so that's a proprietary process that we actually filed a patent on. And, we call it the BOM, the bill of materials process. But we make it fully transparent. It's right on our website, because we feel like it's really important for investors to be able to understand what we're doing. We don't want any smoke and mirrors. So, all of our ETFs, and now I know we're talking about the super cycles, but all of our ETFs are active, but they're active to the rules-based process. So the rules-based process in regard to the super cycles is all about this bill of materials, patent pending process, which is, again, right on our website. But the important piece beyond that, so that gives us our core portfolio, but what's important then is you need people who know what they're doing overseeing the portfolio. So, most investment companies will have, a bunch of smart researchers or, portfolio managers on their investment committee. We took a very different approach. We said, AI, for instance, or energy is moving so quickly. We need people who actually are in the business, who understand, who are building the data centers, who know this company versus that company's products. They know which technologies are taking precedence over other technologies, so we can be nimble. So if you look at AIS, we've got John McNeil, we've got Sunny Madra on our investment committee. They're what we call our practitioners. So their job is to identify risks and opportunities. So we don't wake up in the morning and say, oh, I keep picking on Palantir, but Palantir is down 10%, we're going to buy it. We don't do that. We don't care about that. We're looking for risks and opportunities. So once they identify a new secular opportunity or a risk in the pipeline, the business pipeline of a specific company, then it moves over to, kind of the portfolio construction geeks. That's me and Professor Robert Whitelaw, who is the Dean of NYU Stern School of Business. Then our job is to express their view into the portfolio. So it's a little bit of a different approach to portfolio management overall.
But obviously that goes a lot deeper, maybe plays really well into, I would say maybe another pillar for VistaShares, which is the pure exposure philosophy. Can you maybe talk about that as it relates to those thematic trends that you mentioned, and why maybe believing in these thematic ETFs, other ones outside of VistaShares maybe have failed to deliver? I think you alluded on that a little bit, maybe just saying, hey, this is an AI ETF, right? And it's it may just be a bunch of technology companies, but maybe can you hit really on what that pure exposure philosophy means?
Yeah. So what we do is, as I mentioned earlier with the bill of materials, and we identify the companies and we start looking in their financials, right? So, and this is where this pure exposure comes from. We want companies that are in the AI, in the segment of the supply chain that actually have AI business. And, a lot of companies don't break it out. So we have to really dissect their financials. We got to go through publicly available news information. We have to tap into the expertise of John and Sonny because they know the companies in the supply chain. So we're looking for companies with a minimum of 30% of their revenue into direct AI projects. So,
Healthy amount.
Yeah. So, and look, and that will grow over time. We'll ratchet that up, but it's still it's an early stage industry. So, but if a company doesn't have 30% of their revenue coming from direct AI projects, they're not in the product. I mean, that's kind of the premise behind the pure exposure right there. Clearly we'd like to get it to 75%, but some of these companies are big and they're just getting into the industry. So as time goes, we will ratchet that threshold up. To make sure that we're getting real AI exposure into our product. We don't care about cooling companies. We don't care about AI. We don't care about data center cooling. We care about AI cooling. So for instance, Vertiv, that's the leader in that space. They have a much larger percent of the total revenue in AI related projects. So, so that's the pure exposure angle there. And we do that across the AI supply chains as well as the AI energy infrastructure supply chains for our newest ETF that we came out with.
Well, Adam, something that I think is very interesting to share with all of our listeners is, in addition to those investment pillars that you all utilize, you also have funds that will generate income in addition to those thematic plays. Can you maybe talk about the Target 15 family or the options income ETFs that you all have, and maybe from a philosophical standpoint to help all of us understand, combining equity exposure with option overlays and kind of what some of the target metrics are, whether that's yield, some risk return metrics, and maybe kind of what investors should think about for those trade-offs? Sure.
So our Supercycle ETFs that we just talked about, that they would be bucketed into our growth equity family. We wanted something different that performed in a different market and differently in a different market environment, right? So we wanted, what's become very clear is that income is increasingly important to not only retired investors, but very young investors who are looking to stack dividends and build themselves a revenue stream, for 10 years down the road. And when we looked into the market to try to determine, what's missing, what are the problems with what's out there, we found, the similar stuff, right? There's a lot of S&P 500 products with income generating, using options on them. There's also a lot of these single stock, things that are providing 100%, yield. So we went into the market, we tried to determine what would be interesting to advisors. And what became very clear was that, they would love to access some of these, quote, legendary investors and capture their portfolios. So we started with OMAH, which is, based on Warren Buffett, on Berkshire Hathaway. And, what's interesting about Berkshire Hathaway, it's a very widely held security. And while it's underperformed over the last 6 months in a momentum market, which is no surprise that it's underperformed, it's done extremely well over time. So, but Berkshire B doesn't pay a dividend, right? So, income investors, would like to hold it, but, don't, because no income. So we said, well, what if we can, harness the intellect of Warren Buffett into a portfolio and then put an options overlay over it? So we did our research. We came up with a portfolio. It's always 21 securities. The top holding is we rebalance 3 times a year. So the equity is top holding Berkshire B. And then the next 90%, so it's 10% holding, and then the next 90% is the top 20 holdings of Berkshire Hathaway, the top 20 publicly traded holdings. So the Apples, the American Express, Bank of America, Visa, Coca-Cola, those type of companies. And, we rebalance the portfolio quarterly based on whatever Berkshire Hathaway is doing in their portfolio. And then we run an options overlay that's designed to generate 15% annually. That's the target, but we pay it monthly. So our target is 1.25% per month. We're not looking to pay 1.26 or 1.24. We want 1.25. That is it, because we want stability. We want people to understand exactly what they should be getting. and can expect it. Now, of course, there's no guarantees. We could miss it one day. We haven't, but I always like to say that. So, it's a very simple product, but it's designed as a core equity diversifier, and it's a great product, and it's been our most successful product to date. Based on that success, we brought out a Bill Ackman version, looking at his portfolio. Then we brought out a Stanley Druckenmiller version as well. And again, we are not affiliated with Buffett, Ackman, or Druckenmiller. We are using their publicly available holdings to as a tribute to mirror the portfolio. And then each one of those has the same target 15 options overlay.
That's a very interesting product, Adam, because, like you just mentioned, if you think about it, a lot of investors have confidence in someone like a Warren Buffett, right? And ultimately how Berkshire invests their money. But ultimately lack the ability to, like you just mentioned, invest in what they hold and also receive income. But when you mentioned, if the target income return is 1.25 a month, that's a very healthy amount of income that an investor can receive.
I agree. And that's why we chose the 15% too. It's a little bit above the competitive products out there, but it's way below the products that are paying out, the 100%, the 35% a year, which, there's NAV erosion issues with some of those products. So we wanted to stay way away from that. So give people the opportunity for a stable NAV or a growing NAV. So the primary objective of these products is the income. Secondary objective is capital appreciation. So, if you look at Omaha, I call it Omaha, OMAH, Berkshire was down till Friday. Since inception of OMAH in March, down 4.2%, I think it was, Berkshire B down. So OMAH with the income was up 4.8%. So about a 9% outperformance, versus Berk B in a market where Berk B is not performing well. So, when we go into a value-oriented market, we expect Omaha to, be able to increase its NAV pretty significantly as well. We also have a quality tilted version. It's not based on a legendary investor, but it's using traditional quality screens as QUSA. And that's a great product. And I believe that, we will soon be going into a value and quality tilted market. We've been in a momentum market for so long right now, it's got to switch. So, we think we're well positioned.
Well, I think that also plays into maybe what investors should be mindful of too is, obviously there's plenty of investments out there from a growth oriented standpoint that can certainly meet or exceed expectations and returns, but to not forget that total return, right, is capital appreciation plus income. And it's good to always be mindful that if there's really no differentiation that's out there, like we've talked about in the previous parts of this podcast, being mindful that income can certainly be your friend from a total return standpoint.
Absolutely. Agree. And as I mentioned, it's been a very important piece of investors' portfolio, particularly in volatile markets where you're in uncertainty. You know which way the market's going. You may as well clip off your income while you're waiting.
Completely agree. You've got a very interesting fund, Adam, that I think a lot of people aren't as versed in this. They hear it. I think they like to think, oh, this is great, but I don't think they really understand the true underlying of it. And that's what I want to talk about, your Animal Spirits Tactical ETF, WILD, WILD. So more on the tactical side and a leveraged ETF where you really are going off of sentiment and momentum. How do you think about its role for maybe a longer term investor, to kind of how they should be thinking of it in their broader toolkit, but also maybe some of the risks of daily leverage and rebalancing that they need to be mindful of as well?
Sure. So, this is, again, in terms of the families, a very different product for very different markets. And that's, again, why we brought it out. I like to solve problems in terms of bringing new products to market. So one thing that's been intriguing to me is the increasing use of these double levered single stock ETFs. Double X Tesla or NVIDIA, whatever it may be. I don't use them. I don't tell anyone to use them, but people love them, right? So I just find that, at least for me, I'm not a very good trader. So, I might get the security right, but I'll get the timing wrong and I'll get killed if I bought it. So that's just, I would stay away from it. But it's an interesting phenomenon because when you boil down what investors are doing with those, they're looking for high beta exposure. So I said, well, going back to the institutional bent that we try to bring to everything, let's go talk to institutional investors. Let's talk to institutional trading desks. And, how do they either get their high beta exposure or deliver it to their clients? And what became very simple, very understandable very quickly and consistently across all the conversations is that institutional players do look for this high beta exposure, but typically what they're doing is they typically have a systematic approach to creating a concentrated portfolio of several tickers. They're not going to just pick Tesla or Nvidia. They're going to pick 5 or 10 securities based on, whatever their model is. So I said, well, that's interesting. So, how can we do that and bring that approach to a broader investor base? So what we came up with is, we actually use the single stock double levered ETFs out there as data points. We don't buy them, we don't use them, but we use them as data because what we do is every month, what we're trying to do is look at the fund flows. We're trying to tap into the animal spirits of the market. Where are investors putting their money? So we're looking at the double levered ETFs that are growing the fastest in terms of assets and the ones that are the largest in terms of assets. And we have a systematic scoring system where we score them based on their flows. And based on that, we choose 5 new securities every month. And there could be overlap, like, it might be 5 completely new ones, or it might be only 1 new one, depending on where the flows are. But every month we were rotating the portfolio into the 5, quote, hottest names based on fund flows. We're following the money. And we do lever it up. It's a 2x levered portfolio. So you're getting that extra boost, good or bad, depending on where the market's going, obviously. And, we reset that leverage daily. So it's, we call it, the Alpha Hunter. It's a very interesting product. It's a different approach to that high beta exposure. The performance has been spectacular. Even in these volatile markets, I think we're up 65% since we launched it in June. But again, that can go the other way. If the market has a sustained downturn, it could go down. But, the contention is that investors are smart and we look at them as a group, kind of look at the behavior of the investors. If you follow their fund flows as a group, typically the data says they're generally right. So when you have 5 of these stocks in the portfolio, you don't need all 5 to do well. You just need a couple of them to do well. And typically you're going to see, hopefully go up. So it's just a very different product. It's more of a trading product. If an RA wants to use it, I will always say, well, just be careful, look at it, watch it, don't hold it for a month without looking at it. And, it's for short term, a way to express your views of the market with your eye on it.
That's well said, because it's something that certainly can be beneficial for portfolios, but not something that I think someone should, unless you disagree on this, Adam, should buy, put it in the portfolio and just forget about it. Something to always keep an eye on.
Keep an eye on it, and it shouldn't be a large piece of your portfolio either. Our options income ETFs are core equity exposure. That's the core equity. So, I don't know whatever percent that is depending on your client. Growth equity, okay, but this is a express your view tactical tool.
Yeah, but nice to have that tool in the toolbox. So, So Adam, kind of as we wind down here, there's some questions that I certainly like to ask. We've had a lot of founders and entrepreneurs on this podcast, and obviously, given your journey now building VistaShares and having done what you've already mentioned in the past, and kind of this serial learner and entrepreneur, could you share maybe some key lessons, or maybe if you want to call it guiding principles of your journey as being an entrepreneur and building another business, and kind of what your key takeaways are for success there?
Ooh, gosh, that's a good question. Well, I mean, from a company perspective, always start from the consumer. Whoever your target market is, your consumer is, that's where your product needs to be built from their needs. So everything we do, it's highly researched, it's rigorously tested. We want to make sure that what we are putting into the market, we can be proud of and stand behind, because, if you overpromise and underdeliver, you're done. And so I never want to overpromise and underdeliver. I mean, look, we could fall short on things that we're trying to do because we're certainly not perfect, but we're going to try to avoid it as much as possible. So I think so the quality of the product, I think, is number one. And I think if you have a quality product, that takes care of it. The company building, the building of the company takes care of itself to some extent. And just as more of a philosophical thing, just don't give up, because, just when you think you're done and, it's hard and you can't handle it anymore, that's typically when it switches. And, you just got to follow it through and put one foot in front of the other and keep building and stay positive and be optimistic about your future and believe in what you do.
It's incredible the amount of people who have shared something along those lines, Adam, that are founders of a company that have said that they literally thought the next day they couldn't make payroll, or they couldn't, they weren't going to be able to stay in business. And then they just kept at it, and next thing you know, success was literally just around the corner. Yep. But it's incredible. I guess that's the roller coaster of entrepreneurship. But
it's not for everyone, but it's I'm a glutton for punishment. I can't help myself. I don't know why. But I used to have hair, but no more.
Well, I used to not have any gray, but this business does it to you.
Right. Exactly.
Well, one other question that I do want to ask you, maybe more back on the investment side. In your view, maybe what are some misconceptions about ETFs, whether that be thematic investing, income strategies, that you'd like to maybe quickly share with our audience and the public, as far as maybe, correcting course on maybe some sentiments that are out there?
I mean, not sure I'm really answering your question directly, but I think the most important thing, and I've been saying this since 2006. So I mean, you go back in interviews, I'm saying exactly the same thing, but I think it's even more important now that there's so many ETFs out there, is look under the hood. Just because a ETF has a name on it, it's called something, doesn't mean it is. And more often than not, it's not. If you look in the portfolio, you'd be surprised at what you're getting. So I would just, even if it's the biggest fund in the space, just make sure you're looking at what you're buying, because you don't want to be surprised, and that's the important thing. And then maybe more specifically to options income ETFs, which I do want to explain, is that there's no free lunch, right? So when we're giving 15% income, that's coming from somewhere. So that investors need to understand that an options income ETF, no matter how it's built, what issuer it is never going to keep up in a bull market with the same equity portfolio without the options. So that's kind of important to note. So I always tell investors, expect 75% of the upside, 85% of the downside as a range. Yeah. In a flat to slightly rising market, we can keep up, but if the market goes up, we're going to lag. And I always tell people that, because I don't want them to be disappointed where, if we're underperforming from a price perspective, but from a total return perspective, we're actually keeping up or exceeding. So it's just an important thing that I think a lot of advisors know that now, but there's a lot more advisors coming into the market and buying these types of solutions without really fully understanding how the options overlays work.
And that's important highlight there is understanding that income is coming from somewhere, right? So you can't have 100% of the participation on the upside and also, throw in an extra 15% of the income on top of that. It's just kind of like, it reminds me, driving back to see my folks in Indiana along the highway, I can't tell you how many stores I pass that say biggest fireworks store in the USA. And it's like, well, the last one surely wasn't as big as this one, and I guarantee the next one's not going to be as big as the last one. So it's just, to your point, be very mindful about what you get into, because the name doesn't always fit what's under the hood.
I agree. Dangerous situation for sure for a lot of people.
Well, Adam, this has been extremely enlightening. Thank you, obviously, for making time to come on this podcast and share your insight about you and VistaShares and kind of not only your journey, but also the offerings that VistaShares has for advisors like ourselves to help our end clients. And we really appreciate all of your time today.
Thank you very much for having me. It's been a pleasure.
All right, well, everybody, we're looking forward to having you tune into the next episode, and we will see you then.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.